Hey everyone, me Kevin here. This is crazy. M1Finance, the CEO, Brian Barnes, is on the line. We are going to interview him here live to talk M1Finance. We'll touch on GME, what's going on with Robinhood, and maybe we can find out what's going on at the NSCC. Who knows? Maybe we can find out what's going on at Citadel too. No, I don't know. We'll obviously talk about the app as well. I'm super excited about this. I'm such a bull when it comes to using M1Finance. I love it. I think it's such a great way to keep a diversified portfolio, but also one that's not like so scatterbrained, because sometimes I feel like when I'm investing, I'm like, okay, today I'm doing this and tomorrow I'm doing this. It kind of keeps you in one place. So I'm so excited to bring on Brian and get his insights into everything that's going on in the world today. Welcome aboard, Brian.
Thanks for having me.
Absolutely. So tell us a little bit. You built an app from the ground up. Where did this idea come from? What are you trying to solve? What's different about you? Tell us about yourself.
Yeah, absolutely. So the company M1Finance started about 5.5 years ago, and it was really the manifestation of the personal finance account I wish existed that didn't on the market. I was fortunate enough to be introduced to finance and investing at a pretty young age and just became a personal finance nerd. And by the time I was, 25, 26, the tools that I was using at the time hadn't really changed since I was exposed to the platforms when I was 10, 11. And so I figured every single consumer application outside of finance had been improved in a very dramatic fashion. And for some reason inside of finance was still pretty stodgy, required you to do all the work. It was a data dump of information and was expensive. At the time, they were charging $5, $10, $20 a trade to place per commission per trade. And so M1 started as a automated investing platform. It allows you to create a portfolio of the investments you want all on a percentage basis. Then you just deploy money against that portfolio. It all goes to work for free. We then have expanded to be more of a personal finance suite. And so we offer M1 Borrow, which is a portfolio line of credit where you can borrow at rates between 2 and 3.5% using your portfolio's collateral. And then we added M1 Spend last year, which is a high yield checking account, high cashback debit card, and it moves into this comprehensive platform where you can replace your checking account. Excess money just gets swept into a custom portfolio of the investments you want, an exact proportion of what you want. And if you need to have liquidity, you can tap into a line of credit at the lowest interest rate on the market. So, it started as an dedicated online automated investing platform that I wish existed that didn't, and has expanded into a personal finance suite.
Wow. I mean, I didn't even know there was a checking account. I mean, I know there's a debit card because I happen to have my debit card right here, my M1Finance debit card.
Appreciate it.
Tell me the checking account. I thought there was like a savings account. What's happened? What did I miss out on? And how does that work? Can I write checks from this, or how does that work?
Yeah, so oddly enough, no, you can't write checks from it. So it's a digital checking account offering. It's just sort of the designation that the legal authorities have put on the account. But I mean, it does give you a account and routing number. It's an FDIC insured checking account. So we use a partner bank to do that, and anything were to happen there, funds are insured up to $250,000. You can do really anything you'd want with a digital checking account offering. So you can direct deposit, you can bill pay, you can do ACH movements between different accounts and the like. And then, like you just showed, you have the M1 debit card. And so you can swipe from that and pay at, anywhere Visa is accepted. The big thing, I mean, you were asking, do we have a savings account? The checking account with our paid version, which is M1 Plus, it's sort of an Amazon Prime-esque membership. The checking account pays 1% interest, which is a industry leading rate. And so that's actually higher than you can get in any savings account. So you can still park your cash there, earn an industry leading rate, but use it like a transaction account. So direct deposits, bill, no transaction limits in or out of that account.
Wow. Okay. I mean, that's amazing. So 1% interest on basically your checking account. It's almost like a style of high yield savings. But then, I mean, the big claim to fame here is investing, but now you're in checking accounts. Is this like a precursor to y'all coming out with a credit card too? Like, what's next?
Yes, we might spoil a little bit of the surprise, but credit card is absolutely in our roadmap. Ultimately, we're trying to digitize the private bank experience. You should be able to come to M1, say this is my primary and only financial institution. I use it to manage my money or my finances, not just one component of finances. And any dollar that comes into the platform is just automatically and intelligently routed towards where it could be best used. And so, you replace your checking account, you get a best-in-class yield on cash. You're going to get great cash back on the debit card or credit card when that comes out. You can sweep money into your investments, and you can max out your IRAs first and then spill over to your taxable accounts. And then we have that portfolio line of credit, which I mentioned, but we will also at some point offer more lending options our mantra is always to be lowest cost and most flexible terms. And so, as we come out with all the products, it will sort of be focused on that paradigm.
Is the portfolio line of credit, that's the M1 borrow, like when you click on the borrow tab, right?
That's correct. Yep.
Okay, got it. What do you mean when you say this automatic routing? Like if I have money in the checking account, is this something where like if I need more money in my checking account, does it automatically move money over? Like how does that work? Or is it more like when you have excess money in your account, it goes over into the stocks if you wanted to?
Yeah, you can do both. And so we have an entire portal in the sort of center part of the application called transfers. And you can set up what we call smart transfers, creative branding. And really you can say at any given time, I want between $4,000 and $8,000 in cash in my checking account. That sort of, is enough for a nest egg. I'm earning cash on it. I can cover monthly credit card payments and whatnot, or monthly rent payments. And it is something that if money comes into the account and it goes over 8,000, you can just direct that money towards where you best want it. It can go to pay down a borrow balance. It can go into a Roth account until you max out your Roth account, then it could spill over to your taxable account. And then if you ever fell short, you can also say, hey, where do you want me to fill up that bucket? Do you want it to come from your taxable account? Do you want it to come from your line of credit? And so it's really puts the user in control of saying, here's how I want my money managed on a general basis. And then all the beneficial behaviors are going to happen by default. And then the user can come in and fine tune the dials as they see fit. It's really automating their personal financial plan.
Yeah, I mean, this is a lot more automating than I even thought existed here. So let's see. I've had this particular M1 account for about 2 months or so. I'm just going to pull up here. This is just so we have an example here. This is the transfers tab. So I can move money, but it looks like there's a rules button here too. So I can like set up rules, you're saying, and then move money. See, I've borrowed. What did I borrow here? So I've got this portfolio line of credit available of what? 600. Oh, what a number. $666,000 here is the number that I've got available. So this is the borrow. But what you're saying is I can actually set rules up to where if I get a direct deposit or whatever into my checking account, it could automatically pay off my margin a little bit. It could put some money into the Roth account if I had one. It could do all these crazy things that I haven't looked into, but now I'm really curious about.
It is quite the powerful platform. Yeah, it's really what we're trying to do is sort of reimagine if someone were to work with a bank, have a team of bankers in the background, and really any dollar that came into their life, you would have, a team of 6 in the background sort of optimizing. We're just trying to do that as a self-directed platform and offer it to people with, 5, 6 figures in their account rather than having to work with a giant banker. And so, yeah, you can set up rules and say, M1, this is how I want my money managed. If this happens, do this and the like, and you can prearrange all those rules, and then software takes over and automates all that on your behalf.
Wow. Oh, that's incredible. So like, let's say, we go back to my birthday, January 28th, which is about 2 weeks ago now.
Happy belated.
Tomorrow. So, what happens if I want to go YOLO into the GameStop? Can I set that up automatically? And what happens? Especially that day. What happened that day?
So it was a pretty iconic day in market history. The M1 investing platform is set up a little differently than a traditional online brokerage. Most other online brokerages are built around trading and the trade. So you're saying, hey, I want this amount of this security, whether it's in shares or dollars, this order type, I'm clicking a button that goes through. And they're built for trading. So, buy at 10 a.m., sell at 10:30, or, get in and out multiple times for the day. M1 is geared a little bit differently. We are geared much more towards long-term systematic investing and portfolio management. And so for us, it's less about, hey, I want to buy this security. And it's more of, I want this security to be 8% of my portfolio at any given time. So, you can come in and individually customize that. And you could say, I want GameStop to be 8% of my portfolio. Then anytime money comes into the platform, we're going to do the, intelligent automation and sort of say, hey, if the GameStop is only 4% of your portfolio, more than 8% of that deposit will go into that slice. If it's 12% of your portfolio, less. And so in a fashion, it's dynamically rebalancing, but it's much more built for, this is the portfolio I want to maintain. And then every 2 weeks with my paycheck, I have incremental capital, and I just want it to flow into the investments that I know, understand in the proportion to what I want. So geared quite a bit differently. We do support the buying of individual securities, and we do that twice a day, once in the morning, once in the afternoon, and we batch all the orders together to cut down on cost. And so you can, deposit, the money flows into the portfolio, and you can do that twice a day. During the GameStop mania that happened, you were able to buy in the morning. Our clearing firm, Apex Clearing, let us know about midday that they were going to stop supporting trades for the rest of the day in a handful of securities. So it was GameStop, AEMC, and KOSS, at which point we notified the users that owned those or did want to own those securities during the day that we would be unable to trade for the rest of the day. Fortunately, by the end of the day, before our second trade window, Apex had lifted that restriction. And so we were able to purchase all the securities per usual. And so the impact was actually slightly small, but for a period of time, it looked like we were going to be unable to buy those securities on our customers' behalf.
So really, what happened to? Here somebody has a screenshot. Urgent trading announcement: our clearing firm Apex Clearing is not allowing the purchases of the following securities: GME, AMC, and KOSS. But what you're saying is that notification came out in between your trade windows, because you're only trading at market open, and then I think 1 hour before the close. So that Apex told you can't trade at some point in the middle of the day, but then they lifted that before the close. So in other words, you didn't even really get impacted, is what you're saying.
Yeah. I do think at the end of the day, our trades went through and we were able to operate as normal. For a period of time, we told our customers that we were unable to do this. And so, there was frustration, and understandably so. We as a broker are our clients' access to the markets, and we were cut off to access of those securities, much like our clients were. And so we shared in the frustration. We know that it impacted our customers more than it impacted M1, the company. And so, we did share the news that it looked like we were unable to trade. Fortunately, the impact was minimized, but I do think there was a real impact to our user base by letting them know that, it looked like we couldn't, and that's a possibility of things that can happen in the future, given our back-end plumbing situation.
So in other words, you're saying when people got this notification here, obviously that could lead to frustration, and then they couldn't trade, or they couldn't put these orders in at that time. And even though it didn't end up having an actual impact, like there was no actual restriction, some people probably are like, oh, I can't trade today, and shut down because of that. So is that kind of what I'm gathering?
Yeah, exactly. I think it's people may have changed their behavior, and understandably so. They were given certain guidance, and then they just, I think, were understandably frustrated with, they use a brokerage platform. That's where their money's held. They want to be able to do with their money what they want, which is something that we try to enable, sort of with the product that we offer. And unfortunately, our access was cut off, and it sort of forced us to cut off our users' access. At least notify them that that was likely to be the case for the rest of the day.
Got it. And so this came from you guys, or was this Apex? Like who gives you a phone call and says, hey, we got to stop the tendies on GME. This is getting out of hand. Like who does that?
Yeah. So, the way that the back end systems work within the brokerage industry is there's one central clearinghouse called the DTC. This has now become known lingo, sort of outside of the people who are within the industry. Then sort of wrapped around there are a bunch of other clearinghouses. And so those could be owned by big brokerage firms, big banks. There can be independent ones, and we use an independent one called Apex. And then outside of those clearing firms, they serve broker dealers. And so, and then broker dealers serve the end client. So it's sort of a concentric circle thing from end client to broker to clearing firm to central clearing firm. We were notified by our clearing firm, which is our access to the central clearing firm, that they were going to stop supporting trades within those three securities. And that they are a clearing firm to a lot of the other fintech companies. So us, Stash, SoFi, Webull, Betterment, even though Betterment doesn't support the individual security trading. And we were notified by them that they were stopping access to clearing these trades. And so we unfortunately had no option but to restrict access for our users, or at least notify them that we were intending to.
So nothing you could have done. It was Apex who gave you the call for whatever reason Apex had. They have complete control. So you're just like, crap. The best we could do is just send out a notification.
Unfortunately, yes. Yeah. So, and not to, trying to absolve ourselves of the responsibility, we do use Apex as a vendor. And so we view ourselves as the one who cut off access, but just in transparency, that is the mechanics of what happened. Of our clearing firm shut off our access, and therefore we notified our users that we had to shut off their access. Is that,
is Robinhood, when they're saying, hey, we're the one who shut off access, that's kind of similar to what you said. Is Robinhood different here, though? Like, it seemed like they were negotiating money that they needed to have, and then there were questions of liquidity. Can you speak to that a little bit from what you know? Obviously, I know you don't work for Robinhood.
Yeah, no. So Robinhood is obviously very large broker in the space, one of the premier fintechs, and has, there are tens of millions of users and, a lot of activity and the like. And even prior to their most recent funding had raised a lot of capital. And so they've gotten to the size and scale where it makes sense for them to create their own clearinghouse. And so I forget the names, but there's, Robinhood Markets and Robinhood Securities. And so their broker talks to their own clearinghouse, which talks to the central clearinghouse party. They've been somewhat transparent, maybe not initially, but then later on, that the central clearinghouse basically mandated an increase in deposits due to the risk in the system. I think that what was sort of overlooked is the risk in the system was really counterparties going bankrupt and not being able to clear the other side of the trade. And so, they were worried that people were buying GameStop, the people who were selling it might not come up with it, or the people with huge option positions were going to go belly up and the like. And so the clearinghouse said, hey, if Robinhood goes bankrupt, all the members are going to have to make up the difference. And so they started raising the deposits on some of these clearing firms. They raised pretty substantially on Robinhood, and Robinhood at the time did not have the liquidity to post the collateral such that they could clear the trades. And so that led to the rationale of them sort of restricting one side of the trade, that as people sold, it reduced their exposure, reduced their deposit requirements at the NSCC, whereas people buying it would have continued to increase it and sort of had a spiral effect. And so, it sounds like they shut off access. We can debate whether, seemingly had, material impact within the overall market of what was happening in the securities at the time. And then, had their capital infusion of the billion and then the 2.4 billion to bolster their liquidity to account for scenarios like this.
Wow. So that's interesting. So can you elaborate a little bit on what do you mean when you say counterparties going bankrupt? So somebody listening to that, help.
For sure. So some of this has to do with securities, equities, and most of it has to do with options. And so, the DTC and SCC has been sort of the focus. They deal in securities. There's also the OCC, which is the Option Clearing Corporation, which deals in options. And I do think that they were also a part of this thing, but potentially overlooked. The big thing is, when we're familiar with short selling now. And so, people who are short the security, so short GameStop, have subsequently sold it. So it's not in their possession. They have it sort of a borrowed, but it's, it's only a ledger like balance. It's only sort of a database entry that says, hey, it's on loan, but we've sold it elsewhere. If GameStop, if it was 10% of their portfolio and GameStop 15x'd, they lose money as the security goes up. And so they would have lost more money than is in their account. And so, the person on the other side of the trade says, hey, I don't have any money to cover or repay you for this GameStop. And so the person who bought it basically can't come up with the money. or can't actually get the security. And so that's counterparty risk, is like the person on the other side of the trade doesn't fulfill their obligation due to them going bankrupt. This is even exacerbated further with options, where a lot of people were buying significantly out of the money calls on options, and there's someone on the other side of that. So they were selling a call. And so if GameStop's trading at $20 and you're buying an out of the money call at $100, someone else has to sell that. It typically is the market makers, the Citadels of the world, and they do a little bit of hedging by buying the security. But in some sense, what it was like is a lot of those people were sort of buying lotto tickets of really low cost ways to, if the stock skyrocketed, they could get a huge payout. The difficulty is there's someone on the other side of that, of they're only collecting a little bit of money, and there is a chance that they have to have a massive payout. And there was so much risk in the system that it was a question of whether the people who were fundamentally responsible for doing the payout of that sort of lotto-esque return would actually be able to cover that, or whether it bankrupt them completely. And at which point the sort of like delta spills over into the central clearing firm, the clearing firms, the brokerages, and the like, and it just becomes a disaster is probably the best way to put it.
I mean, in some sense, it kind of sounds like there was a real risk that, we'll use them as the example here. Citadel could have gone bankrupt if GameStop went to the moon, went to $1,000, let's say. There's a real risk that Citadel could have gone bankrupt because, they're writing these options, or they've got to cover the shorts or whatever. And so it sounds like the clearing firms are like, oh my gosh, well, if they as a market maker go bankrupt, that could mess up the whole system. But I mean, looking at it from a user, it almost seemed like that was the goal, to bankrupt Citadel. Because I mean, they're shorting this company that everybody loves. Why not let them go bankrupt? Hey, laissez-faire, sucks for them.
Yeah, for sure. So, just want to be clear, and this is not, me having any allegiance to Citadel. Citadel is absolutely massive, and they weren't at risk of going bankrupt. But there were a lot of, hedge funds or different parties at the table where that could happen. And I think Melvin, and I don't know the particulars of where their risk exposure was, or their balances, or how much it was, but it was very known that they were short and were incurring significant losses. And so there is a thing of, if you have 10 million or 10 billion in their case of equity in the account, and they lose $12 billion, they're in the hole. They're bankrupt. I think the difficulty becomes who makes up that $2 billion. And typically what happens is it's the, for an individual customer account, of which Melvin will have a customer account at one of the large clearing firms, the broker or the clearing firm makes up the difference. And then if the clearing firm goes bankrupt, the entire system makes up the difference. And so it was really the DTC trying to prevent a scenario where all of these losses spilled over, and basically saying, hey, clearing firms, you need to prove that you have the capital such that you can clear these trades, that losses aren't going to spill over and fall onto other parties. And that is the reason that the requirements were raised so significantly across the board. And, on Robinhood, I think they had quite a bit of risk in the system with, their open positions and option positions and whatnot. And it's really incumbent upon the clearing firms to be capitalized well enough to support that, these black swan events that can take place.
Got it. So what you're saying is the DTC, the middle of sort of this centric system you were talking about, they didn't want Melvin, the short seller in this case, to go bankrupt because it would have spilled over and it would have cost the clearing firms money. So in some sense, the clearing firms, or DTC, they kind of did go out of their way to prevent Melvin, the short seller, from going bankrupt because they didn't want to be on the hook for any money. So instead, they changed requirements to make it so that, well, let's make it harder for Melvin to go bankrupt. So it kind of is like the suits protecting Melvin because the suits themselves didn't want to lose money.
So, I'll just add a little bit of nuance there and, hopefully not get myself in trouble.
Sure.
I think the big thing, I don't think that there was nefarious action where it was the DTC was in the pockets of the suits trying to help this scenario. I think the DTC is in the thing of all the parties who are placing trades need to have the capital to clear these trades. it was unclear whether they do. And so they, as the sort of like central person making the rules, said you have to prove that you have the capital to do these trades. I think it had the intended consequence of what you're talking about, that it forced one side of the market, the retail side of the market, who was the predominant buyers, to not be able to buy, which did, I do think had a negative ramification on the security and had price pressure associated with it, which in essence did have the effect that you mentioned, that it reduced the exposure or risk for the suits or the short sellers. It reduced exposure or risk for the clearing firms that, they were going to like lose money and spill over. But I don't think it was sort of a backroom conversation of we are doing it for these purposes. I think it was an incredible amount of risk built up in the system. The central party said, hey, you need to prove that you can handle this risk. The way that the brokers or clearing firms took action affected those on one side of the transaction, but it ultimately did reduce risk, and it benefited those who were selling or short, and it harmed those who were buying or long the security.
Got it. So in essence, this whole system of clearing firms on the evening of the 27th, the morning of the 28th, they're like, crap, we've got this pressure cooker that is really full of a lot of pressure. And, it's like in your pressure cooker in your kitchen, it's on the red level, like a gasket's about to blow. And if this gasket blows, we're going to have a mess in the kitchen. There's going to be, goulash everywhere in the kitchen. And we don't want all this meat splashed all over the kitchen, because then we're going to have to clean it up. In other words, they're going to have to bail out the clearing firm that goes bankrupt, and they don't want to lose any money. So I think, we got to take a little bit of pressure off this pressure cooker. How are we going to do that? Well, we're not going to turn the heat down, because that would be like directly turning it off. But we're going to tell the pressure cooker, hey, you good? You're not going to blow here, right? Pressure cooker, as if it's, I'm animating it here, obviously. Oh, yeah, nope, I don't have enough money. You're right. Okay, all right, let's restrict some things going on in this pot, and it kind of settles everything down a little bit. So it's almost like a backhanded way of turning the flame off to go, okay, let's de-risk this pressure cooker here. And basically, Melvin survives. The clearing firms, the real intention, the clearing firms don't lose any money, but the people who are investing in GameStop get their momentum killed, and GameStop goes from the moon and kind of falls back to the ground. Is that an okay analogy, or I don't know? What are you thinking?
I do think it's a fair analogy. Yeah, I don't think it was, I don't know if I'll go like the goulash pressure cooker full analogy, but it was the DTC saw there was too much risk in the system, said clearing firms, you guys have too much risk in the system, prove that you can cover it. The clearing firms couldn't, and so they sort of let air out of the system, and it did have the effect that you talked about of, it stopped buying pressure on a security that had an incredible amount of momentum behind it.
Got it. So super bottom line, the retail was winning so well that it could, the entire system could have potentially had gaskets blow, multiple bankruptcies, and a bunch of spillover damage. And that spillover damage, we don't know what the ramifications of that would have been, but of course, they're looking out for their own self-interest as businesses, clearing firms. They don't want to go bankrupt. So they're like, we gotta calm this down before it's too late, so to speak. Even though nobody wants to come across as limiting the retail investor, that's basically what had to happen.
Yeah, no, it's a fair assessment. It's, a lot of the clearing firms make up the difference if their clients go bankrupt. And when you're, trading short, trading levered options, you do have the ability to lose more than is in your account. And so they're always incentivized to not let their clients go bankrupt. And so, whether, it's due to regulations, due to, firms making their own decisions, they were trying to let a little bit of pressure out of the system.
So it's not necessarily the SEC or the government saying, hey, we can't have this happen. It was really a clearing firm's self-interest of, we might lose money here if we don't do something.
So I think it's twofold. I mean, clearing firms do have to meet the capital requirements of the DTC. That is a regulated consortium, and that is how securities get cleared. If the DTC says you can't do it, you're sort of SOL. That's the only mechanism to buy and sell securities and get them cleared. And so, they do have to conform to their standards. And when they say, hey, you have to post this collateral or get shut off, they have to post the collateral or get shut off. And if they don't have the collateral, they'll take it into their own hands of what to do. And so, I think it's first and foremost meeting regulatory requirements. Second, reducing their risk exposure that, like, I don't think it was coincidental. Like, people selling GameStop on some of these clearing firms did reduce the clearing firm's risk exposure. And so, it was helping with their regulatory requirement, as well as truthfully helping themselves out as a clearing firm to reduce overall risk.
Got it.
So, it is the incentives were misaligned, and I think in this scenario at the detriment to the retail customer. The opposite can be true at times, but I don't think it was a nefarious, pointed perspective to lead towards that conclusion. But the way that the situation unfolded, actions were taken that harmed the retail investor at the expense of people on the other side of the trade.
Got it. That's a powerful statement. So you had also mentioned that, and I don't know if this was the example or if this is probably what happened, but you had mentioned that the risk was counterparty risk, and the clearinghouses said if Robinhood goes bankrupt, all the members have to make up the difference. So is it, fair for other brokerages then to maybe blame Robinhood for maybe incentivizing the trading that happened, the options risk taking?
I think other people will have to come to that conclusion. I do think Robinhood they position themselves as democratizing finance, but in a lot of sense, what they're doing is encouraging short-term trading, meme stocks, like levered option play, which is fine. There's obviously a demand for it, and people can do with their money what they want. But I think it's a little hypocritical to say that they're doing otherwise. And I do think when they encourage that type of behavior, they should be large enough to support it when it really matters. And so, in times of huge volatility, like we saw last March or February and March during the coronavirus, they have to have uptime. When things like this take place, they have to have the liquidity to post the collateral to clear the trades. And so I do think that it is when they're taking the position of we are supporting levered short-term option trading and the like, they should have the business back-end infrastructure to support that.
Gotcha. Okay, I want to catch up on that. Could I bug you really quick to maybe rejoin the link? Your picture's frozen. Your audio is fine though.
Do I need to leave studio and come back?
Yeah, I'll kick you out of here and then just click that link again if you don't mind. All right. This is a very fascinating conversation. I'm very interested. We'll talk about blockchain as well. This is really interesting. I mean, especially the line here, and I'll go back and replay this, but very interesting to hear that. I mean, really, this was the suits protecting the suits, right? This is the suits like, oh my gosh, we're going to have some spillover damage here. And this is scary. Like, we don't want to go bankrupt, right? Very, very, very interesting. Oh, Brian's back. Okay, welcome back. I can see you moving now.
All right, perfect.
Oh wait, no, never mind. I can't, but I could hear you fine. So
no.
I don't know. Oh well, it's totally fine. Oh no, you're slowly coming back.
I'm moving on my end, so.
Hey, you know what? We'll keep rolling with it. It's totally fine. The technology is a funny thing. So, I got to ask you this. So. Robinhood, okay, maybe Robinhood incentivizes the meme culture and these option trades that lead to more of this volatility, or I think they call it volatility at risk, the VOR or whatever, which affects the mysterious formulas that the clearinghouses use or whatever. Is it then incumbent upon Robinhood to have more cash to prevent this to happen, or is it better to, rather than say Robinhood needs more cash, should we solve the time it takes to clear these transactions. So there is less counterparty risk. Is that a better solution?
I think this can be a combination of everything. I do think reducing settlement time reduces risk in the system, and like even when M1 started, it was T+3 settlement, and there was a transition to T+2 settlement. And there is something that feels a little archaic about 99.9% of these transactions are electronic. They should be able to be settled near real time, even if it was same day or next business day. That's a big improvement, and there's less settlement risk in the system. And so I think that will be a progression and movement. I think the unfortunate scenario is that the system's a little bit clunkier than it probably should be, and so making that migration will take a lot of time. And then I think there's like two bodies that will sort of make the determination on Robinhood. The first is really the customer base of, will they continue to put their money on the platform, trust it as a service provider, sort of knowing that they've had some stumbles, and that's for them to make. It's they can continue to use it, they can not use it. Again, I keep going back to it's their money, they should be able to use the platform. But then I do think regulators will take a very close look at this and say, have we incentivized or like mandated the right capital requirements? We have things like business continuity planning that all broker-dealer firms have to go through. Were the rules being followed? Are they strict enough? Do they account for big scenarios like this? Or I think there's also another argument to be made of this is something unlike we've ever seen in the marketplace before. Sub $1 billion market company getting traded north of 20 billion sort of on retail, like meme culture, which is somewhat new, and not based on the fundamentals of the company. Is that something that we should have known ahead of time, or is that sort of a black swan event? And I think like all of those questions will be debated and discussed, and we'll see how things come out. I'm quite interested of seeing the congressional hearing. I think it's next week, and where hopefully good questions will be asked.
Yeah, absolutely. Do you think there's any risk to the Wall Street bets community? The sharing opinions on stocks, and do you think regulations are going to come down on that, or is this really a clearing firm issue and a depository issue?
I mean, on the community as a whole, I think it would be quite difficult, and there is a little. I mean, this is like sort of the crux of the social media type stuff of, are they a forum or are they a publisher? And, I think like that's above my pay grade to pontificate on. I do think like people will be able to share investment or trading ideas now and into the future. That's well within their right. I do think it like a question will be sort of when does it cross the line, and when does it become market manipulation, and sort of that pump and dump scheme of when are you solely for the benefit of your own account pushing either behavior or like false facts to drive the price of security, at which point you're like causing losses for all the people who got in late. I think like that will be looked at, that there's precedent for that historically. Like pump and dumps are illegal, market manipulation is illegal. I think it would be very hard to argue that an entire community is doing that. I think there's a chance that the regulators come after specific individuals if they are crossing the boundaries of what is pretty known to be illegal and already has precedent against.
Got it. Okay. So probably less risks for, and certainly we don't know, we're not attorneys in that sense, but you're thinking maybe less risk for Wall Street bets. If somebody said something shady, hey, that could be an issue that might get looked into. But overall, it sounds like you're leaning more towards maybe there'll be some fixing of the system itself, which brings up the idea of blockchain. Can that solve these problems?
Truthfully, I'm not an expert in blockchain technologies. I've heard the promises of sort of decentralized settlement and sort of individual ownership of various things. I don't know enough about it. I would say the amount of as a somewhat outsider, the amount of transactions that go through the traditional finance system on a daily basis, whether that's stock trades, credit card swipes, ACH transfers, wires, would overwhelm any blockchain in its current iteration. I don't think that that's any reason that it can't improve and be able to handle those volumes. But the trading that happens on like blockchain and the like is a tiny, tiny, tiny fraction of what happens in the general financial industry. And I have heard that there's been, I don't know, like the cost to process transactions has gone up over time. And so I do think there would have to be improvements before it was ready for the full financial system to be on a technology like that.
Got it. So now maybe not ready for mainstream yet then. So maybe the next step is going to like a T+1 instead of a +2 to try to reduce some of those risks and volatility. Although who knows when we're going to see the next, GameStop blow up and the short squeeze the way it was, huh? I think Vlad over at Robinhood mentioned he called it a 5 sigma event, a 1 in 3.5 million chance of happening. Is he BSing or what do you think?
I'm sure the models talk about that as a 5 sigma event. I think the funny thing in finance is 5 sigma plus events happen way more frequently than they should, sort of given the underlying math. And so this is sort of like Nassim Taleb's territory that there's more tail risk associated with like random crazy events happening than typically gets accounted for.
So what might in the models look like a 5 is probably more like a 5% chance of happening. So somewhere between a 2 and a 3, huh?
Yep, and it is something like the unfortunate scenario, and it gets on both sides. Is a lot of what adds risk to the system is really out of the money options, like whether they're calls or puts, and so it is something that with very small sums of money, you can have pretty big notional risks. And you talk about the 5 sigma events of it's quite unlikely for a standard company to go from $20 a share to $300 a share in a given day. But when that happens, and for whatever reason, this one was that like the small dollar amounts created insane notional exposure risk. And so I think that is truthfully probably the thing that's going to get looked at the most is, how much leverage can you bring into the system, sort of knowing that these crazy events can happen that can, have crazy spillover effect to a lot of different parties. And it's an interesting question because it's, should people be able to do it, or, are people accounting for the risk when they do it, and who owns the risk and who shares it and the like. And so not the easiest questions to fundamentally answer.
Wow. Yeah. I mean, that almost opens the door up to wondering, like, should there be more of a limit in terms of how out of the money a call option you could actually buy? It's kind of what you're implying, right?
Yeah, exactly. I think it always becomes a tough scenario when the potential downside risk spills over to a third party. And, it is something that if it's between two parties and, one loses a lot and one gains a lot, I think everyone's okay with that. I think it's when one wins a lot, the other loses a lot, and that spills over to parties who weren't even involved in the transaction. It becomes a little questionable of, do you put guardrails around that? And I think that's what regulators will look at in a very meaningful capacity.
Well, speaking of guardrails, when are we going to get the Dogecoin and the BTCs on here?
So, a lot of our users ask about crypto, and truthfully, I think we thought that there was going to be Bitcoin ETF, crypto ETF, that we would sort of get it for free by just operating in the system. It's taken a lot longer than we anticipated it taking. We continue to evaluate it. It's, we evaluate it. It's on within our product roadmap. There's no definite timeline of when we're developing in the crypto space. Got
it. And what about, people want to be in the SPACs. How am I going to get into all of the latest SPACs?
So the vast majority of them we support on the M1 platform. It is something we do have limited, thresholds for limited market cap as well as limited trading volume, just because when we do trade in a daily trade window, we have the ability to move the market in a very meaningful capacity if there's limited trade volume. And so we do have to put a little bit of preventative measures of the automated system doesn't support low volume securities very well. That being said, like if there's ever interest in a particular security, you can ping our customer support, and we evaluate it and try to add all that we can. Truthfully, it's like hard to keep up with all the specs coming out. So, we're adding them as fast as we realize that they exist.
You got to get the Matterport one in there, the 3D scanning GHVI. Yeah.
I was a big user of the product when looking at homes and condos and whatnot, so I'm supportive.
Oh, so you know about it. Okay, good.
Yeah.
So what about, how do you guys make money?
Yeah, so M1 has the 3 products, M1 Invest, M1 Borrow, and M1 Spend. We also have a membership program called M1 Plus, which is sort of an Amazon Prime-esque membership. It's $125 a year. We're currently offering it for free for a year, but it gives you benefits across the entire platform. So more trading options, lower rate on Borrow, and higher cash back and interest rate on Spend. But on each of those 3 products, we still make money despite that. So we do, on the Invest side, people can hold cash, which we can monetize. We do securities lending, which is, because short selling is sort of in the news, we can take securities that people own and lend them out and monetize the securities that way. And then payment for order flow also in the news. On M1 Borrow, we lend at rates between 2 and 3.5%, and our cost of capital is significantly less than that. So we earn a spread on whatever we're lending out at any given time. And then on the Spend side, anytime someone holds cash or swipes their M1 debit card, we can monetize that. On the cash, we're lending it out primarily to banks on an overnight basis. And on the debit card side, we make what's called interchange fee. So it's a percent, like about 1.3% of whatever goes through the M1 card from a dollar transaction volume. So it's a lot of littles. Ultimately, if people use M1 as their primary financial institution, the lot of littles adds up to something reasonable and meaningful, and allows us to build a quite vibrant business on it.
When are you guys going to SPAC so I can invest in M1?
We're probably a little early. So, from a company standpoint, we started 2020 with, 40 employees and about 800 million on the platform. We're now north of 3.5 billion and have 120 employees. And so we're, quadrupling our our employee base sort of year over year, continuing to grow as fast as we can. And 2021 has been more significant growth than we've ever experienced, sort of even despite quadrupling over the last 12 months. And so we're growing fast. We'll become a meaningful company in a short amount of time. We're not SPACing in any short amount of time, unfortunately.
Well, I mean, Nikola didn't even have revenue when they SPAC.
Yeah, we could make a drawing of the platform that we're going to create. And
yeah, I mean, just all you need is a prototype, man. Come on, I could SPAC you.
if you set it up, if you're our sponsor, we will entertain it. I can't I have to be dicey around committing to anything, but so.
All right, folks, we got to figure out how to SPAC. Somebody please post in my Discord how Kevin can create a SPAC. We got to do it. So moving on then, one or two more questions here. So, I mean, you really appeal to the kind of investor who is going to be able to park a lot of their money with you, or their checking account with you, and who wants to kind of passively grow their wealth, not so much the trader. Do you see, any changes coming to that? Do you see any more trading windows coming in the future for people who want to get in, the action a little quicker?
I think over time we will add capabilities and capacities for, wanted things like more trading options and the like. And so, it's very feasible that it's more trading options or on-demand type stuff. M1 will always be geared more towards long-term systematic investing, portfolio management, wealth management, and creation, rather than some of the more short-term things. And I think it's two things. It's like philosophically, we think that that's a incredible way to build and manage wealth over long periods of time. And then the other thing is there's a ton of other companies doing the short-term stuff incredibly well. And so, there's a little bit of where do we see the market being underserved? Where do we, as a philosophically sort of buy-in of how we want to manage our own money, as well as where is the opportunity? There's a lot of competition in the high-frequency trading stuff. What's actually odd is we think that there's less competition in the person who has 5, 6, low 7 figures, who is thinking about their retirement or kids' education or first home, who has incremental capital to put to work every 2 weeks with their paycheck, who has $250,000 and may want to leverage that to borrow at really low rates rather than sell their securities and incur taxable events. And we think that that's a demographic that is underserved, and we're going to hone in and focus on building for.
Got it. That's actually really interesting that you've got that. It's almost rather than maybe somebody who's doesn't have a job, but they want to do a little bit of day trading or something like that. That's not really the target anyway. The target is somebody who has a portfolio. They don't have all day to focus on their portfolio, but they do want to have access to cheap capital. Is that right?
Yeah, exactly. If we were to analogize it to a different industry, I think, if we did the auto industry, there are sports cars, which might be the trading firms, and we produce an SUV. And it's not to say one shouldn't exist or one is better than the other. They serve two different purposes. And I think we're just squarely in the SUV utility type camp.
Got it. Okay. Now you mentioned this phrase, which is a hot potato. I got to ask about it. It's one of our last questions here. Payment for order flow, man. Public ditched it. What's your take on it?
Yeah, so I mean, does it make sense to explain a little bit of the dynamics of how payment for order flow works?
Sure.
Okay, so I mean, when a retail customer places a trade with a brokerage, the brokerage has a couple different ways that they can execute the trade. Some internalize it, though that's becoming way less frequent. But the big thing is they can place it on major exchanges. And so New York Stock Exchange and NASDAQ, and then there are regional exchanges, or they can send it to what are called wholesalers. And these are the people who are doing the payment for order flow. And really what they're doing is electronic market making. And the big thing is New York Stock Exchange and NASDAQ post all the trades in their book publicly. And so there's a spread, and it might be a 5-cent spread. So you can sell at $10.05 and you can buy at $10.10. And the New York Stock Exchange is going to charge fees for that. And they're also going to capture the entire amount of the spread. A lot of these wholesalers came to the thing and said, hey, we can do this electronically. We don't have to have a specialist or a person sort of matching the orders. And we don't need a 5-cent spread. We can do a 2-cent spread. And so they, like all these market makers, the Citadels, the Virtues, the Jane Streets of the world, basically created systems and says, we are going to compete and we're going to operate in between the spreads of what is posted on public exchanges. And so they're making less than the public exchanges on spread capture, but the way that they're making up for it is in volume. And so they are trying to buy volume from the brokerages to send the order flow to them. Really what happens is when we send our order flow to the wholesalers, the Citadels, the Virtues, the Jane Street, they are actually guaranteeing that they are going to execute at best price or better. And it is something that, 70, 80% plus of the transactions happen better than the publicly available quote. So ultimately it is benefiting the end consumer. Spreads are tighter. You're getting better execution than you would get if we sent it to the major exchanges, but it does create a conflict of interest. And I do think it also, it brings a lot of trades out from the open into these sort of like dark pool type things. And so I don't think it's as nefarious as people expect or think. And it actually has led to more consumer benefits, but I do think it's less frequently understood. And the unfortunate scenario is it's making money for a lot of these like scary firms like Citadel and Virtue who sort of operate in the shadows and just make money hand over fist. And so something does feel a little bit more nefarious than what I actually think the market dynamics are for payment for order flow.
Wow. Thank you for that explanation. So where does somebody go if they don't do payment for order flow? 30 seconds.
So public denounced, so they're not doing it. I think Fidelity doesn't do payment for order flow. And then Interactive Brokers has two versions. One's a free version where they do accept it, and the other is a paid version where they don't accept it. So there's a bunch of different options. I think like for M1, we do accept it. It's quite negligible in the grand scheme of things from a revenue perspective. I do think there are bigger transaction costs, whether it's the entire spread, the taxes, and the like, than the payment for order flow. So I do think trading is more expensive, sort of just due to the behavioral stuff rather than the tiny amount that is in payment for order flow. Got it.
Awesome. Well, geez, this has been phenomenally insightful. I really appreciate that. Tell us, like, how do people sign up for M1 Finance? Where should they go? Any kind of specials or any final thoughts that you have about this? I really appreciate your time.
Yeah. So, I mean, best place to sign up. I mean, I think there's a link that Kevin posted that when you deposit $100, you get a $30 sign up bonus. We are running that promotion. You can also sign up on our website, M1Finance.com, and then we're in both app stores. So Apple App Store, Google Play, you can search for M1 Finance. We're also available on all the major social media sites.
Got it. Got it. And then let's see. Yeah, I guess that answers it. I'm excited. I mean, I'm looking forward to your credit card, your new products. I got to look into some of these smart routing things you've got. I think it's phenomenal. Thank you so much. This was a blast. Big shout out to you, and for everybody watching, thank you for watching. If you found it helpful, consider subscribing and sharing the video. We'll see you in the next one. And thank you so much, Brian.
Yeah, thanks for having me. It was a lot of fun.
Thank you.